In the meantime, the effect on the market seems to be dissipating for now from the concerns over the Omicron variant and its latest spread. Let's talk more about what we're seeing in the markets and what we could see going forward. Hugh Johnson is with us now. Hugh Johnson, Advisors CIO. Good to see you, Hugh.
Nice to be with you.
As we, you just heard what we were talking about in terms of the Omicron variant. We have seen what seems to be a weight on the markets from it. But we've also been trying to sort of parse out how much of it is sort of end of year effects, how much of it is COVID concerns, how much of it is fiscal policy concerns, and how much of it is the Fed, I suppose, as well. Throw that in there. Hugh, how are you thinking about all these different threads?
Well, there's a lot coming at us at once, and it's all, quite frankly, conjoined. And let's start out with COVID or the Omicron variant. And I'm getting reports this morning, and I don't know if you've gotten these as yet, that it is significantly severe. In other words, my question is, and the big economics question is, will this have an impact on the US economy? And the answer I'm starting to get is it certainly won't be as significant an impact as we saw at the beginning of COVID, which is March and April of 2020, but there'll be some impact on the US economy. Now, that sounds like bad news, and it is bad news. But at the same time, keep in mind that the Federal Reserve is talking about not only tapering, but after tapering, raising interest rates, and raising interest rates much more aggressively than we previously thought. 3 times in 2022, 3 times in 2023. But while they're considering raising interest rates, they're going to be watching all the economic numbers and the inflation numbers. So to some extent, the COVID breakout or severity issue is a somewhat, I don't want to call it good or a blessing in disguise, but it's going to have some impact on the numbers they're looking at in the first and second quarter 2022. So maybe they'll back away from that very aggressive view that we're going to raise interest rates 3 times in 2022. I can't begin to tell you. I could say they're making a blunder. They're about to make a blunder. I really do think that's the case. But if COVID gets them to back away from 2 to 3, or let's say 3 increases in interest rates in 22 and 23, that's going to be really good news and very important news for the financial markets. That means that the hit, quite frankly, to PE ratios, interest rates will be going up, PE ratios coming down, the market won't be doing as well. That hit will not be as severe as I've been worrying about. So I hate to call it a blessing in disguise, but all of this stuff is mixed together, and let's not leave out the fact that we're talking about fiscal restraint as well. We're talking about the problems in Washington and the chances that Biden's program will not get through. I think there's some encouraging news today that might go through, and therefore we'll get a little bit of fiscal stimulus. So this is all about monetary and fiscal stimulus and how much we're going to get and whether it's going to lead to the end of this cycle. And I'm crossing my fingers that when I look at the configuration, I say, I don't think it's going to lead to the end of the cycle, but you've got to watch all of these variables.
Fed, Hugh, let's just call it like it is. Would the Fed be off its rocker to raise rates at all next year? I mean, look, we're seeing mobility being impacted, more lockdowns overseas. I understand they have to try to control inflation, but to raise interest rates when economic growth is decelerating seems pretty ridiculous.
You're saying it like it is. I probably should say it like it is as well. I probably use even stronger words than you've just used. I used the word blunder before. I think that it certainly qualifies as a blunder. I, for the life of me, cannot figure out why the chairman of the Federal Reserve has done the pivot that he's done. It looks to me like he's responded to political pressures in Washington, and that's not good for the independence of the Federal Reserve. So I'm a little bit shaken by that. And you're absolutely right. You raised the question, should they raise rates at all in 2022? Well, based on the fact that the economy is slowing, based on the fact that I think a strong case could be made that the rate of inflation is going to come down, I have it coming down to 3.5% from the current level of 6.8%. And I have that happening in the second, third quarter of next year. You really have to ask that question. Should they be raising
Hey,
rates at all? And maybe raise
Hugh,
one
Hugh,
time.
Hugh, I have to interrupt you for a moment because if you're asking
Sure.
this question, you're one of the only people that we've talked to who are asking this question. Most people are going the other way. They're saying the Fed's late. They're saying the Fed has not been aggressive enough. This is not a consensus view by any means that you're expressing, and you're talking about the economy slowing down, but it's slowing down to a faster rate than it had been pre-pandemic, right? If you look at a GDP forecast for next year, you've got a high inflation environment. You've got maybe not a full employment environment, but you're looking at the unemployment rate that is at a pretty low level here. So why wouldn't the Fed raise rates given those variables?
Simply stated, Julie, in response, is that you're coming out of a deep hole. So you're going to get very high numbers for GDP and very high numbers. I could go through the math, but high numbers for inflation coming out of that. But it's all headed towards, it's slowing. And yes, the numbers are still fairly high. Your number for the fourth quarter is probably going to show GDP growth of between, maybe 6 and 7%. And that is a staggeringly high number. But remember where you're coming from and where you're headed. You're headed towards what I would call normalcy, which means numbers like 2% gross domestic product, and I think still elevated 3.5% inflation rates. And under those conditions, what should monetary policy be doing? Should it be leaning towards restraint and trying to slow the economy even more? My answer to that question is no, regardless of what everybody thinks. And so, quite frankly, and especially take a look at the dot plot in September and the dot plot now. We've moved from one rate hike in 2022 to now we're talking 3 rate hikes. It's very fickle. It's very volatile. And that's true not only of the Federal Reserve, but also true of a lot of private sector economists. And the private sector economists that I talk to are all saying the same thing. They're saying the economy is slowing. It'll slow in 22. It'll slow in 23. Yeah, maybe you raise rates one time, but you don't raise rates 3 times in 2022. That's way too aggressive, period.
We shall see, Hugh, but always good to get a contrarian point of view on this and all matters from you. Hugh Johnson, Advisors, CIO. Great to see you and happy holidays, Hugh.